begin our session, everyone. Welcome to the session. This is Jose Blasco. Welcome to the SMARTT Target Live session. So let's begin our session, everyone. Turn off my volume here. Welcome to the session. Today it's March 31st, 2022, last day of March. Can you believe it? And we are ready to begin our market analysis, learning more about options, having a little bit of fun together, isn't it? Because we are all passionate about the markets and passionate investors and traders, and more specifically options traders, on the way to becoming options traders. And in that sense, I'm delighted to be here. Thank you for having me, Tiger Brokers, and thank you all for joining the session and being part of this. I love it. Thank you so much. So let's begin with the session, and very quickly, agenda. So we have a very brief introduction. We'll talk about key headlines. We'll talk about options from a lesson point of view. Lesson of the day. We'll talk about the markets, understand better what is the market position at this moment in time, what's the market environment, what to expect, where risk or opportunities may be. And we'll discuss about all of this, most importantly from the angle of options trading, meaning that we are not going to only look at market data, kind of like generic type of market data, but we'll be looking at specific data coming from the options markets, which often reveals what's going to happen in the market, because typically the very large traders are using the options, and therefore whatever you get to spot on the options arena ends up many times translating into price movement on the charts, and we kind of get to see it just a little bit ahead of time. Okay, so we'll talk about this. That's why we call this market analysis, this market commentary, we call it SMARTT. Okay. And of course, throughout the session, feel free to ask questions at any moment in time. We'll have a Q&A at the end if needed, but I would kind of feel that probably it's even a better idea if you want to throw questions at me throughout the session. And if the answer is coming later, let me be the one to tell you, but just feel free to interact anytime. And talking about interaction, I would like to test that everything is going well, sound is good, screen sharing is good. You guys are ready for this, so a quick message on the chat box will be appreciated, even if it's just a quick hello, or yes, sound is good, or hey, I'm ready. Anything friendly, go ahead, go for it. I didn't say, I also have a bonus for you guys. So later in the session, right before we do the market commentary, right after the options lesson, I'll share what it is. But again, always happy to share materials or tools or possibilities for you guys to develop yourself and become a great options trader. Okay, talking about tools to help you to trade more and better, you can see on the screen there is a QR code with a 0 commission card for US options trading. This is thanks to Tiger Brokers, and if you haven't used that yet, so this is the time for you to use it. Okay, and the QR code is there. I'm sure that these may be posted later as well on the chat box or something like that. But again, the QR code is here, so you better take it. Very good. Thank you so much, guys, for your feedback there on both on the app, on the Tiger Brokers app, as well as on the YouTube channel. I see you all, guys. I'm monitoring the 2 chat boxes, so I don't miss you. And I don't miss your questions, so I can help you as much as I can. Okay, so again, one more time, feel free to interact and participate. I can see many of you are quite shy. I see the numbers of attendance and I see the messages I received, which makes me feel that some of you are a little shy. Okay, so please do not be shy. We all had a time in our trading life where we were learning, and we had those basic questions, right, that maybe we didn't dare to ask. Go for it, my friends. I'm here because I love it. So make sure you take advantage of those sessions. Okay, my name is Jose Blasco. Again, I really dislike spending time on this slide talking about myself. Really, these sessions are about you and about the markets. But long story short, I trade all assets. All assets goes pros and cons. I love stocks. I love futures. I love forex. I love crypto. I love options. I love everything. I love the markets. But if I have to pick something, to be honest, I would pick options, because as you saw on the beginning of the presentation, options give you options. I'm used to work in the technical field. My background. Thank you so much. Thank you so much, Sammy and everyone. In prior years before I was a trader, my background was, my job was related to engineering field, and I am an engineer I studied engineering in the uni. And in that sense, it's kind of like options giving me options. It's kind of giving me those moving parts that make trading richer. Okay. Having said that, nothing wrong with trading all the other markets, which I trade as well. But listen carefully, because options is something that may you may develop this crazy passion like I have myself, because options are really cool as an asset. In any case, here is our website as well. Another QR code, another URL, tradewithufos.com. This is our website. I won't spend too much time talking about what we do. The only thing that may catch your attention here is UFOs, if you haven't been in a session before. So UFO stands for on-field orders. Basically, this is the underlying force that pushes prices up and down. So if you have plenty of buy on-field orders, prices will go up when the orders get filled. If you have plenty of sell on-field orders, prices will go down when the orders get filled. So knowing where those orders are, it's critical to place trades or plan trades in a proper way. The UFOs on the chart, they look like flying saucers. You can see the picture there. And again, the next thing you know, so we call them UFOs because they look like flying saucers and is the acronym for on-field orders, okay? Very critical. Anyway, so let's talk about headlines. And again, if you have been in the sessions with me before, I'm very pragmatic with the headlines. Sometimes, there are businesses out there in the media arena where they make it a business of talking about news and headlines. And that's the only thing they do, talk about news and headlines, and they can spend 3 hours talking about the inflation, Russia, Ukraine, etc. And I'm not saying that's wrong, it's absolutely fine. But my approach is much more pragmatic. I'm just representing on this slide what I believe matters at this moment in time. I can have a very bad joke here. We can talk about things such as, what happened in the Oscar ceremony. Okay, very bad joke, as I said. Again, that's not being pragmatic. I'm just going for what may have the potential to truly, really impact the markets. And in this case, of course, we have Russia and Ukraine. You've seen the moves in the markets. They are no joke. Not only the moves to the downside, which kind of like you would have predicted, because, a war is always a bad thing. And you would think it generates fear and all of those things, and then you would feel the market's going to fall. But then we've seen amazing moves to the upside, and certainly that's just as relevant, if not more. So it's important to keep in mind, what tends to happen when those particular pieces of information are, out there. In this case, in a conflict between two countries or more, or also the inflation. Which is also a very big problem, especially because, when the Fed meets again and they, decide if they want to raise interest rates again or not. So now the question is not if they're going to raise them. The question now is, are they going to raise another 0.25, or is it going to be a full point or half a point? So all of those things are being priced little by little as we're waiting for the news. And when the news comes out, depending if it creates a disappointment or not and how big it is, we often have these very large price movements. So those are the two things that, in my mind, are the most important at this moment in time, even though we can make a long list, but those are the two most important ones, which have been on my slides for a while now, okay? 33 earnings reports is what we're going to see today. To be honest, today, it's a very boring day from a report point of view. Most of the companies reporting earnings are quite small. One of the biggest one is Biocept, which is not very well known, meaning that it's not that big, even though it's one of the biggest one today. And the second I had in the list, to be honest, I just had it because it brings a smile on my face, a smile to my face, which is BlackBerry, which again, depending on when you started using mobile phones and if it was in the corporate world or personal, you may have never used a BlackBerry, but if you were in the corporate world at the time, BlackBerry was a complete revolution where, email went mobile. And it was the very, very relevant device that did that. And then, the company, I guess, didn't, I'm not a marketing expert, but I guess the company did not adapt well to the changing markets. And these days is not that relevant. So that's a small stock. That's what I'm trying to say. But at the same time, it brings a smile to my face because, I was in technology. BlackBerry it was a big player in the past. Okay. So again, we don't have anything too big today, only 33 earnings reports. We are not in earnings season. And therefore, the reports that we have are typically small companies. You'll see a few weeks from now where every time I bring a list of companies reporting earnings, everything is going to be like large companies, known companies, the Walmarts of the world, the Apples of the world. We'll see that, but it's not the case today. Okay. Anyway, so let's get into our lesson. Jimmy, nice to see that you are getting into options. You are new to trading options, so listen carefully. By the way, someone was asking earlier in the Tiger Broker app if there were recordings from the prior sessions that we have done, and the answer is yes. You can find them on the Tiger Broker app. You can find them on the YouTube channel with Tiger Broker Singapore. So find them and watch them because we are building up, right? So I'm building more stuff on top of stuff we already discussed. So those recordings are there. And, if you're new to trading options, it would be very healthy for you to go and watch. Okay, cool. So the lesson for today, okay, it's a long title. I'm going to read it carefully because, to be honest, there are many, there is already a lesson within the title. Okay, so if you guys allow me to read it. So risks and opportunities attached to the fact that options contracts have expiration dates. So key, contracts, options have expiration dates. They don't last forever. If you buy or sell one, it's not a trade forever. There is a moment in time where it expires and the contract is gone. That's a huge, huge, huge thing to realize. The other thing is that particular behavior of an options contract, or characteristics, I should say, imply that on one side of that equation, you have risks that we need to understand so you can mitigate those risks and don't get yourself in trouble and then you lose and you don't know why. But on the other side of that equation as well, we also have opportunities. The fact that options expire, to be honest, is source of great opportunities too. So again, the idea in today's lesson is to go a bit deeper into this so you understand both sides of the equation. So you can start developing your trading plans, trading rules, trading preferences. You start realizing what makes the most sense to you. And I'll give you examples of what I mean by that. Okay, but let's begin. So first of all, let's go very basic here and let's define exactly what is an option expiration. Okay, and how often we have expirations and and what happens with that. So, well, first of all, options expirations, they refer to the dates in which options series cease to exist. In other words, today, you could buy an option that expire tomorrow, Friday, right? Or the Friday after, Typical expiration date for options is on Fridays, right? So I'm going to use Friday as an example. So let's say you buy an option that expires tomorrow and the stock doesn't move or whatever that is, or you got distracted and now you come back on Monday and it's like, okay, what happened to my trade? Well, guess what? It's gone. You would not see your trade in your account any longer because the contract has expired. So the options series cease to exist. Okay, so it's a hard end of the life of the contract, and that's it. Okay, so we need to keep that in mind. When you buy a stock, for example, there is no expiration. I mean, you could say that you buy a stock, and if the company goes bankrupt, it's like expiration because the asset disappeared. Great, that would be a good example, but it's not based on time, it's based on an event, which in this case, it's based on time. And the good news is that those times are predictable because they are listed. They follow a pattern that we call the option cycles, which is set based on the financial regulation. So options are listed by exchanges, and the way they list options is on using those series, which some of those series are monthly series. And monthly series means that those options expire every month. But the question is, every month when? Is it the last day of the month? Is it the first day of the month? No, it's the third Friday of the month. And by the way, all of these, as written on the slide, refers to the US markets. Okay, so this is not referring to options in India, for example, or options in Germany. This refers to US options, okay, because each country has different regulation. And for example, in India, it's a different day. It's not on Friday, okay? But anyway, so in the US, third Friday of the month is a very important day. Also, typically, third Friday of the month, that's when futures contracts expire, which may be every month or not, depending on the asset. But again, that third Friday of the month, historically speaking, it's a very relevant Friday in the month. So you need to remember this by heart. If you didn't know it, now you know third Friday of the month is key, okay? Now, there was a moment in time, that was over a decade ago, that exchanges and regulation launched weekly expiration options, okay, where those weekly expiration options are expirations, option series where the expiration takes place every Friday, okay? So then what's the difference between a weekly expiration and a monthly expiration? Well, technically speaking, there is one difference, which is, if there is an assignment or an auto exercise, the settlement takes place over Saturday, if it's a monthly expression, or if it's a weekly expression options, the settlement takes place on Friday itself, because weekly expression options were born in the computer age and it's all computerized, where monthly expressions, some of them are still trading in the pits and things like that. And, there is still a manual kind of like process, and they push it one day to Saturday, which is, again, from a practical term for traders, it doesn't matter, because even if the option assignment and settlement takes place on Saturday, you cannot do anything, because the last time you can trade that options contract is, let's say, 1 second before the Friday close on the Friday expiration. That's the last time you can trade it. After that, the moment the market closes on Friday, you may be auto exercised, you may be assigned, the option may be out of the money, in the money, whatever that is what it is. And then the settlement will either take place on that Friday if it's a weekly expression option, or on the Saturday after the Friday if it's a monthly expression option, which again, for practical terms, is the same, Friday. So how come they are all called weeklies and the one which is the third Friday of the month is called monthly? Well, this is inherited from the fact that in the past, long time ago, there were no weekly expiration options, and therefore the options that expire every month were on the third Friday of the month, and they're called monthly. So that term has been inherited. So as an options trader, when we say I'm trading weekly options, okay, we often refer to options that expire every Friday, without really pointing at the fact that it's first Friday, second, third, fourth, or fifth Friday of the month. We don't really point at that. But technically speaking, if you were to be a purist, know that the third Friday of the month is not a weekly expression, it's actually a monthly expression, even though I myself and many traders will simplify it and say weekly. Okay. The quarterly expiration options, it's an option that expires on a different date. It's the same thing, but just expires on a different date, which happens to be the last business day of the quarter. So if the last business day of a quarter is Tuesday, so that's the date. If the last business day of a quarter is Sunday, so then it would be the Friday before the Sunday, because Sunday you cannot trade. Market is closed. So very simple. Last business day of the quarter. The leaps, that's a different animal. It's an option that expires in the very long term. So every time we are looking at options that expire, one year and beyond, typically we are talking about LEAPS, okay, which stands for long-term equity anticipation securities. Again, it's very common. You don't say, hey, I'm trading monthly expiration options that expire 1 year and 6 months from now. You don't say that, probably because it's too long. You probably just say, I'm trading LEAPS, and that's it. Okay, that's when you would normally say as a trader. And then there are other cases where everything I mentioned is the classical type of options that probably if you read an options book or something like that, you knew existed. There are more options out there. There are more expiration dates available, such as Monday and Wednesday expiration in certain products. For example, if you trade S&P index options or RUT options, RUT, which is the Russell 2000 index. So when you trade options on indices, not all of them, but some of them have lots of demand, and therefore exchanges not only are listing options that expire on Fridays, but also on the Mondays and the Wednesdays. Same thing happens with very few, but a few stocks that are super liquid, and also some ETFs that are very, very liquid and huge demand. For example, the SPY ETF also has monthly and Wednesday expiration options every week. Okay. So again, how do we call that? Well, there is no name for that. So Monday and Wednesday expiration options. Okay. That's how we call it. We cannot call it weekly because the weekly expiration options are the Fridays. Okay. So anyway, very simple, but again, just so you guys, when you start training yourself, taking a course, reading a book, and you hear those terms, you know what it is. Okay. So this is very basic, very foundational, borderline with descriptive, a bit on the boring side, if I can say, if you don't mind. But at the same time, we need to know the terminology. We need to know our stuff, because options give you options. There are many ways to combine them. And if we don't speak the same language precisely, in futures lessons, I may tell you, hey, I buy a call, using a monthly expiration, and I sell a call using a weekly expiration. And next thing you know, you may not fully understand what I said, because while we're using words that make sense in English language, you didn't get, or you never saw the specific meaning attached to how it works in the options arena. Okay, so just spending a little bit of extra time there, defining this, as this is a foundational lesson. Okay, I hope you don't mind. and you are with me. Please, time for feedback before I continue. How is it going so far? Quick message on the chat box. No one is shy, okay? No one is shy. If all is good, just type okay. It doesn't take much, but it makes a big difference on my end. Please interact with me, guys, because again, it's a big difference on my side, okay? If you have any question, feel free to type. This is a good time as well. So option cycles are often called options expirations. Okay, it's kind of like a term that is used interchangeably, which the reality is that it's not right. The meaning of option cycle and options expiration is a different story. But it's very common, myself included, that sometimes we'll say, hey, use an option expiration of 3 weeks from now. Well, the right way to say it would be to say use an option series that expire 3 weeks from now. Options expiration refers to a date, not to a series. And I want to bring in the concept of a series because every time there is an expiration date, attached to that date, you have a series of options, right? So you have the 100 call, the 105 call, the 110 call, the 115 call. All those options expire on that same expiration date. So what you trade is an options series, but we often say you use that expiration, and some people will say you use that cycle. Use the March whatever cycle. And again, it's not right. Cycle refers to the fact that there is regulation that works in a cycle, like in a pattern, where every cycle, X amount of options contracts are released by the exchanges. For example, at all times, as it says on the 4th bullet point, you have at least 2 expiration series set 1 month apart from each other and 3 additional series separated by 3 months each. That's the minimum you will have when a stock is optionable. Even if it's not liquid at all, you will have at least this amount of series. So it's multiple series available, multiple dates available that you could use to plan your trades. If the stock is more liquid, you may have more. You may have more. You have weekly expirations. You have Monday and Wednesday expirations. So you may have more. But the minimum you have is this, okay? And those are series those series are listed the way they are because it follows the regulation for option cycles. But having said all of that, which hopefully is understood, the fact is that in the end, we all say, hey, I'm trading the March cycle. Hey, I'm trading the April expiration. And that's incorrect, but we all understand what it means, and it's fine to say it like that, okay? So I just wanted you to know the purest definition and the common way to use this terminology. So options exchanges list new option series on a regular basis. Options traders, we always have multiple expiration dates available, so you can be short-term, mid-term, long-term. You can always build an options trade. Weekly expiration series are available when the stocks are very liquid, and then special products like the SPX index or the ETF SPY also have those Monday and Wednesday expirations. You can actually even call the exchange and suggest that they release. Okay, sorry, not call the exchange, call your broker and ask your broker, please, I would like to trade options that expire on that date and they are not listed. Can you please request the exchange to list that date? You could actually do that. Different story is if the exchange will consider giving a yes or a no, which has normally a lot to do with the demand and the liquidity of that particular stock. But you could actually request for dates that are not listed. Okay, all of this is doable. Very good, guys. So I'm looking at comments. Very good, very good. I see you guys on the YouTube channel much more engaged and interactive compared to you guys on the Tiger Broker app. I'm wondering why is that? Come on, guys. I'm here for you, my friends. I would really like it that you guys are a bit more interactive with me, guys, so I can help you better. For you, okay? My friends, you often see me looking down and so on is because I'm looking at my phone and things. So let's talk about, remember we talked about risks and opportunities, okay? So let's talk about risks and opportunities out of the consequence of the fact that options got an expiration date. Let's talk about it for options buyers first, and then let's talk about it for options sellers next. So when buying options, no matter the expiration series used, options traders, we can exit our trades anytime. Okay. Oh, the Tiger Broker app doesn't allow you to chat. I understand, Daniel. So that's probably why I don't see any message on the Tiger Broker app. That may be maybe someone forgot to just switch on some switch. So the chat is active. I'm not sure if that's the case. If it's just a technical glitch, I apologize for that. But in any case, I'm watching, okay, guys? So if you guys are chatting, I'll be watching you. So going back to the first item on the list, okay, options traders, we can exit trades anytime. So a common misunderstanding when it comes to new options traders is that, okay, let's say I buy an option that expires on the third Friday in April. So now I need to hold that trade until the third Friday on April. And that is not correct. While options have expiration dates attached to them, you could trade options in and out whenever you wish. You could actually do intraday trading of options if that was your choice. You enter now and you exit, 5 minutes later, 2 seconds later, 5 hours later. Whenever you decide, you can get in and you can get out, even though there is a specific expiration date, which is a future date compared to today. So in other words, we typically use those expiration dates in the context of a trading plan with rules to try to make the trade as cheap as possible, as smart as possible, as performing and smart as possible. But at the same time, it doesn't mean we ever plan to stay there all the way until the expiration date. Actually, that would be quite inefficient because most of the time value portion of the option would evaporate if you waited to be too close to the expiration date. So normally when we buy options, we give ourselves extra time so we can get to our targets with extra time left, and then we can sell those options and make a profit. You buy the option today, the underlying moves, the option gains value, you sell the option on that other day, and then you make a profit, which is the difference, okay? So no need to hold options contracts until the expiration, even though they expire on that future date. In order to profit efficiently, buyer of options need large stock movements to happen ideally quickly, soon, okay? No waiting time. In other words, if you buy an option, let's say you buy a call, and you probably remember a lesson we took a long time ago, right? Pick up the call, right? So if you buy a call, you need the stock to go up for you to profit. So let's say you buy a call on a stock, and let's say the stock just moves a little bit up, a little bit down, a little bit up, a little bit down, and it really does anything significant, and time keeps passing. So what's going to happen? Well, not only you are not making money because the stock is not moving, but on top of that, you are suffering the effect of time decay, because as time passes, you are approaching the expiration date, and the option is losing its portion, it is losing value from the extrinsic portion value of that contract. So you are basically, it's kind of like the effect of a melting cube, right? So you have the cube there. If nothing's happening, the cube stays there, it starts melting. So it's a little bit of the same effect. Your call is losing value because the stock is not moving. So options buyers, we need the stocks to move. If they don't move, it's a problem. It's a bad thing. Okay. Now, different story, and we'll talk about this in future sessions as well, is that there are trade management techniques beyond what I have discussed so far, because everything I have discussed so far, almost every time, is having me trade one option at a time, isn't it? So you buy a call, or you buy a put, or you sell a call, or you sell a put. Most of my explanations have been on the basic side so far, but the reality is that as an options trader, you do trade management, you sell options against options you buy, you do things, and in cases of the stock is not moving your way, so you could actually apply techniques to alleviate the problem derived by the fact that the stock is not moving. Okay, so it's options give you options, okay, as I said earlier, which is cool, but we do need a move to happen, right? So if you want to make money on that call or that put, you need a move to happen. So when stocks move too slowly, it often takes too much time to reach the trader target, which has multiple consequences. All of this is hurting the P&L. You are losing money on time decay, plus on top of that, the implied volatility is typically going to contract, which is going to contract further the extrinsic value portion of the option. So you're losing money in 2 ways or more because the stock is not moving. You need the stock to move, okay, if you buy options. Options traders facing undecided markets that don't move with decisions may need to close their trades ahead of time to avoid taking losses, okay? Question here, okay, for the ones of you who have traded options before, question, this one, to be honest, I will understand if you don't want to answer, because I'm going to ask you if you ever lost money trading options. So if you don't want to answer, I get it. But to be honest, for in order to benefit for the benefit of the community, let me phrase the question, and if you were to be kind to answer that question, it would be very helpful for the new traders. So here's the question. The question is, have you ever been in a trade where, let's say, you bought a call and the stock moved higher, but then you did not make money or very little, and you were very disappointed by the P&L, or actually you were right, and actually you lost some money on the trade? Has this ever happened to you? Okay, please answer that question on the chat box if you are kind. With the community, if you, I mean, all of you are kind, okay? But I would understand if some of you would say, you know what, that's very personal, I don't want to answer, so I get it. But at the same time, it's something that has happened to so many options traders, and it's because they felt into this hopeful situation where you buy the call, the stock is moving a little bit up, next day is moving a little bit down, but the next day is moving up again a bit. So now you hope it's going to continue next day, but the next day it comes back down again. And then you're like, oh my God, should I close the trade? But the next day is moving in your favor. So now you're hoping again. And then the next day, maybe it moves 2 days in a row and you're like, that's it, now it's moving. And then it drops 3 days in a row and now you don't know what to do. And all of this is happening while time is passing. And now, thank you so much, guys, for confirming this. This is very kind of you guys. And for the new traders in the room, this is important that you realize that when you buy a call or you buy a put, you need the move to happen sooner, because if it doesn't happen quickly, notice the responses on the chat box, you may not get performance. Again, there are trade management techniques to alleviate that, and we'll cover that when the time is right. But if you were just to trade a call, this or a put, this could happen when you buy options, okay? So when trades are working well, and in order to avoid auto exercise, traders may need to roll their options contracts to future expiration series to be able to stay in trades longer past the original expiration date. So let's say, what does that mean? Let me give you a scenario, an example. And I see a question from Johnson as well. I'm coming to you, Johnson, in just a moment. So let's say you buy a call and you expect the stock to go to this price level. But next thing you know, with a major gap and a major continuation of the move, the stock keeps going and going and going so much that you decide, you know what, instead of taking profits now, I'm going to let my profits run. I want to set a way further target. And, this is an unbelievable move. Let's stick with it. Let's say that's part of your trading plan. Again, all of this should be and needs to be surrounded by rules, so you don't improvise or are subject to trading psychology traps. But, again, let's say you have a set of rules to do that. And next thing you know, the stock keeps going and going and going and going and going. And that second target you set, which is further than the original target, it's not going to be reached on time, because now expiration date is going to take place before you reach that final target. So what can you do? Well, if you do nothing and you hold the contract where the stock went very nicely in your favor, in other words, that contract got plenty of intrinsic value, and you hold it all the way to the expiration date, and you're an options buyer, we talked about it last week, isn't it? You're going to be auto-exercised. And now you own shares of stock, which is not a big deal, but it is a big deal from a margin requirement and the quantity of capital needed for you to be on the trade. For you to buy a call, you need very little capital. For you to buy shares of stock, you need much more capital. So remember, you will be auto-exercised, and now you own the shares. So your deployment of capital in the account is totally different now. Okay, so you need to be aware of that. And if you want to avoid that problem and you want to stay in the trade to reach the final target, but you don't want to deal with shares, you want to continue working with calls. So what you would do is you would do what we call rolling, which is a fancy term to saying you close the call that is about to expire and you buy a new call with a further expiration date. So rolling is nothing else than closing the call you currently have and buy a new call with a further expiration date. That's it. We just call it rolling. Because when you roll and you got rid of that call that was going to expire, then there is no risk for you to be auto-exercised, and therefore you stay in the trade with this new options contract that expire further in time, and now you expose yourself to reaching that new further final target that you set. Okay. Hi, could you please recommend some books of options exercise? To be honest, the one I would recommend you, but it's really a tough one, okay? Because really, to be honest, in my experience, I had a very difficult time throughout my options career to find good books on options, and the ones that are very book are normally very heavy to read. So the one I would mention to you is the one called Options as a Strategic Investment by Larry Macmillan. That is a very good book, but it's like 1,200 pages, something like that. So it's a real thick book, like serious stuff. Okay, so not too fun to read at all, but good stuff inside. Okay, so that would be my recommendation. Yolo Kai Kai, I'm sitting on a 50% loss on NEO, which expires in 8 days. What do I do now? Okay, well, let me show you that on the charts in a moment. I'll give you an alternative of what I can do. Right now, I cannot really write comfortably on the screen. In a moment, I will be using the platform. So I will show you something that you could do that may help. But again, since you are only 8 days to expiration, there is not too much you can do because you let too much time pass to put you in a position where you are too close to expiration, and now you cannot do too much magic. Okay, but I'll give you an alternative of something that you could consider doing. Very good. Perfect. Johnson, if I sell a put option, how to exit? You buy back the put. And by the way, you are reading my mind, Johnson. Next slide talks about selling options. Okay, so what are the risks and the opportunities really attached to selling options instead of buying options? Remember, with buying options, you need the move to happen, right? Well, with selling options, you don't want a move to happen. Okay, you want the opposite. But anyway, let's begin. So no matter the expiration series used, options traders can exit their trades at any time. So when you sell an option, in this case, Johnson is asking, what about a put? What if I sell a put? Yes, you can close the trade anytime. And the action to close the put you sold is buy to close. So just like you did sell to open, then you do buy to close, right? Just like if you buy a call, you buy to open, and then to finalize your trade, you sell to close the call. So let me repeat it slowly. If you sold to open the put, to close the trade and finish the trade, either for a profit or a loss, you buy to close the put. Okay, buy to close is your action. And you can do that anytime. You don't need to wait until expiration date. Of course, if the stock moved against you, in this case is a put. So if the stock went down, okay, if the stock went down, then you would have lost money because you would need to buy the put for more, right? Puts make money when the market fall. So if you sold it at 5 and the stock goes down, that put may become 6. So if you sold it at 5 and you buy to close at 6, so you lost the difference, which is 1. Okay, you lost $100. But you could do it anytime. You don't need to wait until the expiration date where the stock may went against you way more. And on top of that, now you are obliged to accept delivery of the stock because you're going to be assigned on that put, right? And you're going to get the stock put to you. So you can sell the option anytime you want. You can buy it back anytime you want. Even though there is an expiration date, it doesn't stop you from even going to an extreme, trading options intraday. Not a problem. You could do it. Okay. Let me see the questions there. Larry Macmillan, and the book was Options as a Strategic Investment. Okay, options as a strategic investment. Daniel, how long do you sit on call position intraday? That depends on your trading plan, Daniel. When we get a bit more advanced with the lessons, I'll get into some trade examples and things like that, and I will show you how we do it. And I'm looking at the time, and I need to keep going here. Later, if I have time, I can show you a mini example with a platform, because obviously the slides have a different topic on it. Okay. But anyway, what does it say here? Time passing, it's probably the only sure thing in the marketplace, and therefore the fact that options have expiration dates often works in the favor of options traders. So this is the opportunity. In most things in life, you will think that you get something and that thing expires is bad. Well, no. If you sell the thing that expires, is actually good. It's like you are an insurance company. You sell an insurance contract to a car driver. Then the car driver didn't have an accident. So at the end of the term, you kept the premium and you did not have to fulfill any obligation to repair the car from that driver. So it's perfect. Time passing helps you. Okay. So same thing when we sell options. Okay, that's the opportunity. Okay, option sellers sell options and wait for time to pass to enjoy the effect of time decay. Having various expiration series available help traders to maximize the effect of time decay by choosing the expiration series with the greatest amount of implied volatility. I, as an options trader, I do many things. Some of the strategies I utilize in options trading are intraday strategies on the Mondays, on the Wednesdays, and the Fridays using SPX and RUT. Okay, so those are intraday trading strategies with options, using options that expire in just a few hours on market indices that are cash settles. Okay, this is one type of strategies I exploit for myself, apart from trades on other assets that I hold for multiple days and things. So again, I run diversified portfolios, in this case, diversified in the form of different option strategies. That's beautiful because you sell an option that expires 1 year from now, the rate of time decay is very slow. But you sell an option that expires intraday, the rate of time decay is super fast, right? Because it expires in hours. So now, of course, you get paid less, right? But it expires faster too. So, okay, so there is a trade-off, and it's certainly something I enjoy doing. Okay. Good. Sweet one Eng. Does that mean that sell put ideally should be at a shorter period so that is expired soon? From an efficiency point of view, yes. Now, from a trading plan point of view, it depends. Because maybe you are selling a put, as we said last week, as an investor. And the reason why you sell it is not because you want to collect premium and benefit from the time decay. The reason why you sell that option is because you want to take delivery of that stock so you can hold the stock in your portfolio, and you are selling the put as an investor would do. That's different compared to what I do when I trade options intraday, as I just explained. When I do that, I'm not trying to take delivery of anything. Actually, I'm doing it on the SPX index, which is cash settled, where I will never take delivery because it's cash settled. So I'm not getting put anything to me, and I'm taking called away of anything. I'm just doing it in a way that is cash settled. Okay, so that's a totally different application. And there, in that sense, yes, the shorter the expiration date, the more efficient the benefit of the effect of time passing. But it doesn't mean you need to do it like that all the time. It really depends on what you're trying to do and therefore your trading plan. Remember, options give you options. Even traders who trade, let's say, stocks, they may have very diverse trade plans with different methods on how to trade. Well, imagine in the world of options where every option strategy could have different applications depending on the trader. Okay, selling a put to a trader could be making money on time passing. Selling a put to an investor could be like, I'm hoping the stock is going to fall, so it's put to me, so I now own the stock and keep a premium. Totally different approach, even though it's the same action, sell a put. Okay. Nunt, I bought an option at higher price but cannot sell back because there is no buyer. Is it happen often? Yes. Well, yes and no. I'm guessing what's happening to you is that you are too close to expiration. So if you are too close to expiration, then that's a typical thing to happen, especially if the option is far out of the money or far in the money. Typically, you may not have bid size or ask size, or the spreads are very wide and it's very difficult to get filled. And again, what's the issue? If that was your case, not saying it's your case, but if that was your case, then the issue is that you waited too long. You put yourself too close to the expiration date, and no one wants to trade and take the other side of the trade because there is no time left on that option. So why would someone take the other side, right? So that's the issue. The other case could be that you are trading options on a stock which is illiquid by nature, and therefore you're going to suffer liquidity problems, which is you may not get filled. Okay, so that would be a different story. But I'm kind of guessing that probably the issue is the other one. Okay, because if the stock is not liquid, okay, you get a bad price, but normally you get in. But if you are simply not getting filled, typically is that you are close to expiration. You are too close to expiration. Okay. Kai Xiang Chen, will this lecture cover options trading, or when is a good time to buy options? Well, not this lecture, but certainly I have many plans of covering many things about options and that too, but one at a time, okay? One at a time. I wish I could do like this, and everybody is a very advanced options trader, but as you can see, there is so much to discuss. There are many what ifs, and every one of those what ifs in options trading are opportunities, but also risks, okay? So we need to spend the time to do this right, okay? Here we go. Okay, so my friend, time to move into the charts. Before I move into the chart, and by the way, a very good question and very timely question, Kai Xian Chan. I join you guys here typically, a few times a month in the Tiger Broker ecosystem, which I love. But beyond that, with our company, Trade with UFOs, we are running live trading almost every day. You can see the calendar on the screen where almost every day we are running live trading, where we actually prepare trades, we discuss trades, we talk about rules, we plan trades, we execute trades. and all of the above. So my commitment is to help you guys to develop yourself. Obviously, by meeting 2-3 times a month, I can help, but there is so much I can help because we need more time, isn't it? So I am inviting you here with this QR code and this link to join our coaching plan. You have a free access there for 3 months of our coaching plan, and you can attend the sessions live with us or watch the recordings. You come onto our website. By the way, not too happy to acknowledge this, but just so you know, we are having a technical issue on our website. So when you come into the trading room, you may need to refresh your browser a couple of times to be able to come in. I'm sure this will be fixed any moment, but just saying later tonight, to be precise, at 11 p.m., I will be doing live trading of options in our website. So if you want to join me, you are more than welcome. Use this QR code. Our activation team will get you activated. Your username and password will allow you to come into the trading room. You may just need to refresh a couple of times and you join me there and we'll be doing trades. Okay. So you can certainly do that. And you have it for 3 months. Okay. So that, Kai-Sian Chan, hopefully will be helpful to you. But in any case, I also plan to break it down in the format of lessons like we are doing now so I can help you better. Okay. Cool. Okay. So with all of this said, I'm just going to stop sharing the slides and move to, I need you guys to give me just one moment because I need to share my other screen where I have one of my trading platforms. So we can do our SMARTT. You guys to give me just one analysis of the markets. One of my trading platforms. So I believe you guys should see me. And the SMARTT analysis of the markets talk about all of this, you guys should see me, okay? And all of this, the SMARTT analysis of market climate, calls and puts, implied volatility, option volume map, etc. Let's do one at a time. All of this, the SMARTT analysis of market climate, calls and puts, implied volatility, option volume map, etc. Let's do one at a time. All of this, the SMARTT analysis of market climate, calls and puts, implied volatility, option volume map, etc. Let's do one at a time. Sorry guys, I'm having this market climate, calls and puts, implied issue on the screen. Okay, I guess I made a mistake when sharing screen. Let me do it again, guys, if you don't mind. Oh, yes. Very novice mistake. Like I have never done a webinar before. You should be able to see my screen now. One second to get confirmation to see if I see the screen or not. Yes, I believe so. I believe we are back to normal. So, hey guys, I'm just gonna, because it's getting late, I'm just gonna go through the market analysis, the SMARTT market analysis. Sorry for that, for the interruption here with my screen, but let's go for it. Okay, so what you see here is the trading platform. This is, we call it TOP, is the Trading Options Planner, is one of the tools that we have as a company. And the first thing I'm going to focus on is auto climate. So I'm charting the SPY ETF. So we're looking at the US market, S&P markets, and we can see that the current market climate, okay, it's a dark blue dot, which represents a confirmed up climate on the S&P. So that is very positive. And to be honest, it's an impressive move, the one that we had to the upside. When I mean impressive, I really mean it. A move of this magnitude in the context of a very risky global situation with the conflict with Ukraine, Russia, etc. This is absolutely, truly unbelievable. But it happened, right? It happened, and it's happening, and it's in front of us. And in that sense, we have to respect this market condition. It's very strong. Okay. Now, from another angle, I will say that statistics suggest that the duration of this type of climate is 6 candles at a time, and we've been running in that particular market behavior for already 11 candles, okay? And on top of that, okay, on top of that, if I maximize my chart from the left here, on top of that, notice that they have a measurement here called max distance, which is 1.02, and notice that the current max distance is 1.69 there, that was achieved just a few days ago. Okay, so what does that number mean? Well, that number represents a statistical definition of what too far too fast is. Too far too fast is 1.02, and we actually reached 1.69. So the market has really statistically overstretched all the way, apart from the fact that it's been not only overstretched, but actually lasting too long in this upward condition based on statistics. Okay, so what is to be expected? What is to be expected is to see this market go down. Also, notice how today we got an Elliott wave indication, Elliott wave turning points, a wave to the downside with a final target to be 425. So we could certainly see this market relax from this very aggressive move, go back to 425 before resuming and continuing what potentially probably, based on statistics, is going to be a beautiful uptrend. But we should have a correction before that to be able to enter safely. I also said that last week, where we were in the middle of this climate, and I was saying, we're in the middle, we are getting to 6. So, hey, this climate is more likely going to reverse than not. And next thing you know, you have this massive euphoria kick in, right? Bringing this to levels which are statistically unlikely, but that's what statistics means. Sometimes they are met, sometimes they're not. In this case, they're not. But again, it's to be respected. This market is extremely overbought, and we even got an Elliott wave turning point now. So yeah, so we should see that market go down. This opinion I just shared with you, which is just my opinion out of utilizing our technology, can also be seen when we look at the implied volatility of the puts versus the calls. The blue is the calls, the gray is the puts. Notice how the puts are more expensive than the calls. Why would the puts be more expensive than the calls? Well, there is only one reason. More people are buying puts and less people are buying calls. That's the only reason, right? Or more people are selling calls and less people are selling puts. Whatever you choose, it's all bearish, right? So from the options data point of view, we can see bearishness coming in. We don't see the candles go down yet, but we do see bearishness coming in. Okay, so note of caution there for the ones of you who are long. Consideration of taking profits and so on is certainly or probabilistically a good way to think about what to do next when it comes to your trade, or maybe start planning on getting short. Okay, even though to do that a bit safer based on statistics, you will want to see a red dot, which we don't have yet. That would be the indication of a new down climate. Okay. What else? S&P futures trading at 0.07% up, which is basically flat. So today, when the market opens, it's going to open where it left yesterday. And where did it leave yesterday? It left at the very, very in entrance of two red UFOs on the chart, which represent a stack of unfilled orders to sell. So in other words, if the market is here, we got the blue climate very stretched to the upside. We got options that are revealing that a lot of put buying is happening, which is very bearish. And on the chart, we see unfilled orders waiting to get filled to sell. So we should expect at least this market to come in here and come at least to this green UFO before bouncing back up, at least. Again, when I say at least, this is not a certainty or a financial advice of any sort. That's, I guess it's well understood by everybody. I'm just reading the results of the market analysis done by our tools, which are based on probabilities and statistics. So statistically speaking, what I'm saying is that I would not be surprised to see the market fall. Okay, that's what the market condition is leading into. From a volatility point of view, though, notice how the red line is deep within the blue lines. So we talked about this in prior sessions, and this represents calm. So if the market falls, again, it doesn't mean it's going to fall forever. I mean, a down climate may represent 2 candles on the way down, maybe a bit more. Okay, so it's either we drop all the way to this UFO and from there we bounce, okay, which that would be very much in line with what the red line suggests. Or if the move to the downside is going to be greater, well, we got plenty of UFOs there coinciding with the orange area which is the ending part of the Elliott wave to the downside, which is potentially starting, since we have the orange dot on the chart. So in other words, nothing to panic about, but certainly careful if you're long. That would be the conclusion of the market analysis here. From an options volume point of view, again, notice that on the expiration date of April 4, we got 1.1 times more calls traded than puts, so basically parity. But then the next expiration, 1.6 times more puts than calls, gray color is put, 1.4 times more puts than calls, 1.4 times more puts than calls, 1.7 times, 2 times more puts than calls. So again, plenty of puts being traded, more than calls in most of the expiration dates. So to me, the very key point here is located at 460. I'm looking at open interest. Notice the important relevant open interest here, here, and here at 460, right? So 460, we got plenty of open interest. That could be a very strong technical resistance point in the markets, lining up perfectly with those UFOs. So again, if the market rallies and hits those price points close to 460, you got lots of resistance coming from the open interest of the options prices, on-field orders on the chart, the market condition with the Elliott wave likely going to start. All of these combined, I don't mean to be bearish, like, I'm expecting the world to end at all, but certainly in the very short term, I am expecting the market to move down way more than moving higher, even though the market may surprise us and continue going higher a bit more before there is this change of climate. But again, quite unlikely based on everything I just said. So this takes care of the market analysis. Not sure if you guys have any question about the market analysis. I see a few additional questions. I'm speaking very fast because I surpassed the ending time of the session. So I'm trying to complete the session. Luis WKQ, I sold a put option, but the price went down. A friend told me to buy 25% of the quantity I sold to close my option. I did, but later I was still forced to buy when the price went below the options price. Well, that may mean that you had multiple put contracts and you only closed a few of them. You didn't close them all. So let's say you sold 2 puts and you bought back 1. Then you are still left with 1 put short, and then you are subject to be put shares to you. So yeah, it doesn't matter if you bought back at 25% more or less. If you still have some of those puts in your account, then you have obligation and you are subject to be assigned. Okay. Yeah, and again, talking about when to close event, there is no rule which is generic that applies to all ways on how a person can trade. That is the right rule to apply. Okay, in trading, this is like, I'm not sure if you guys are fans of Formula One. I am a big fan of motorsport and Formula One. This is kind of like setting up a car. 2 drivers in the same team that have the same car may set up the car to their liking with different angles for the wings and things like that, because when they drive the car, they have a different driving style. So in trading, it's the same thing. I will need to know more about your trading rules and trading plan, so I can then elaborate and talk about trade management techniques that could be helpful to you in your specific case. And I could totally understand that some of you, many of you maybe are new to trading options and you are experimenting, you don't have a plan yet. It's fine, so good, but you need to get there. You need to have a plan. You need to learn it well. Join me in the sessions. You can join me again at 11 p.m. It's a bit late, but if you want, I'll be there. And we'll keep working on that and more to come, okay? One step at a time. But, listen to this advice carefully if I can. Just learn this well, my friends, okay? Because options is amazing, but you have to do well, because then if not, there are certain risks that you may not be aware of. Like, for example, I got assigned, I don't know why. You need to know why, okay? Because if not, you are not managing risk properly. So learn it well, don't be in a rush, learn it well, and then, you have a skill for life there, okay? So happy to help. I'm very passionate about this, both trading as well as, being part of this community and helping you guys. So make sure that, you are not shy and you are just, you are open to collaborate and interact, okay? See you soon, my friends. See you next time. Tiger Brokers, thank you so much for hosting the session. And everyone, thank you so much for attending and making this a joyful moment for me. Thank you so much, everybody. Take care. See you on the 20-something of April. I don't remember the date, somewhere there. Okay, that will be the date. Bye-bye, everybody. Take care. Enjoy the celebration next week. Bye-bye, everyone.